Hi guys, welcome back. So I guess today I would go over the market first because some people might be getting worried. Especially yesterday's video, I gave out a warning to stay alert for the market correction, maybe for market dip. So let's look at Dow Jones first today. Right now, Dow Jones has been going weak for over a week already. As we know, it was the strongest out of all the index because of all the infrastructure plan. But recently, it's going through a correction and it doesn't seem like it's gonna stop tomorrow. So I guess it might continue at least for a few days. So meanwhile, the money might be still within the tech stocks. So this is my first opinion. With that said, Nasdaq was down 0.7%, the most out of all the index. For now, it looks like it's getting supported by the 5MA. I think it's caused by the FOMC meeting, and we should expect there should be some volatility for these days, especially this Friday is the quadruple witch day again. Quite an important day, and this is when usually a lot of the funds would change a lot of the positions they're holding in their portfolio, so it would create a lot of up and down movements for individual stocks. From the look of it, it doesn't look like that big of a dip because it's still above the 5MA. It is around 2% from the first support here, 13881. But if you compare the Nasdaq composite with the Nasdaq 100 index, you can see that the dip today looked better than the Nasdaq composite. It did not touch by the 5MA, it's supported by the opening price of yesterday. And same thing with the QQQ. So that might mean that the money was in the big techs these few days. And that is quite normal because if we expect a lot of volatility within these few days, then there should be big funds to get into the FANG to make sure the index doesn't fall. Like Apple, it grew 2.46% yesterday, very strong move, and then followed by a very slight dip today. So it looks quite healthy for now. So if the market expects volatility, that means they would move the money to the big techs to be more safe as a safety place to park the money. So with that said, I think we need to be more careful. First of all, if the money is pulling out the big techs, that means they would be getting out from the growth stocks, the small caps. So if your stocks have been growing quite well recently, rebounding a lot from the bottom, chances are money might be moving out without you realizing it. So it's okay to take some profit, to lock in some profit. And second thing is, tech stock had been growing for so long, ever since May 12th, the bottom, and Dow Jones had been consolidating for so long, mostly moving on the side. During the past a week and a half, when Nasdaq was growing almost every day, Dow Jones was dropping almost every day. And I still believe that right now we don't have extra capital in the market, so it's the same amount of capital rotating between sectors. And when a certain sector gets too hot, this is usually time the smart money moves out and start to get into the other sector that's cooled off already. So watch out for the money to move out from tech stocks and back to Dow Jones. I don't know exactly when, but we need to watch out for that, and it doesn't hurt to have hedge against our tech stocks into some recovery play or values just to be safe. There's nothing to lose because value stocks, when they drop, they don't even drop much. And if the tech stocks you like had a dip you like, you can always swap it to buy the dip. It's like holding cash but not losing the opportunity cost. On the other hand, the Chinese market yesterday did not do so well. I also gave a warning in my video yesterday. I said I would expect it to pull back to touch this purple line at least, 3520. Right now we backtested 3547 yesterday, breaking the support of this long time consolidation. So it doesn't look like it's gonna stop here. I thought it would have a last jump before dipping back. So I guess it just pulled back directly then. If there is some rebound, chances are it might continue going down a little bit more. So that would be a good chance to take profit from your current position that you are happy with. So it fell 0.92% yesterday, but it was a big red bar. At some point dropping 1.16%, not a little bit. And as you see, it could create much more dipping for our individual stocks. Strong correlation ones would be examples like JKS. It followed the Chinese market and had a very big red bar, dropping 11%, and did not seem like there was buying the dip. So my Discord member asked me if it's good to add JKS now. So I said it might be safer to wait a little because you can see the whole day it was just dropping with no or minimum rebound until the end. I thought it could hold at the 200 MA, but no, it just broke it with one day, breaking 3 support lines. So it looks like it can dip back to around 37. It was growing with strong momentum, healthy run up, but I guess that's why we have to look at the index as well. Otherwise, very little stocks can survive when the market goes south. And it's the same thing with TIGR. It has a strong correlation with the Chinese stock market, as I explained before. And this is typical, climbing up with stairs and coming down with elevator again. During the day, my Discord member asked, is it now a good entry point for TIGR? And I said, no, I don't think so. At that time, it was dropping 12%, and you see there is no one catching the falling knife, just continue dropping. It was 25 at that time, and I said I think it would at least take 2 weeks to consolidate on the side or fall to lower support. Meanwhile, I can use the money to catch other dips. At least wait until TIGR to be 22 to 23 to start considering. But at least now it dropped to 23. It did seem like there were some catching the dip. So it looks like it can rebound a little first. So guys, this is why in a market like this, when money moves so fast between stocks and sectors, it's dangerous to chase the stocks that's gone up high. And it would be actually the same thing with EH. Even though this is a lot of our top holding, but still, we had the chance to buy the dip when it was low, and if you missed it, then I think it might be dangerous to chase after the takeoff. Especially it had grown so much during the last 2 weeks. The position I added myself at 22 was already up over 100%. So of course we would expect a lot of people to take profit here. And now this morning with the news, it was trying to take advantage of the earning news to exit, I think. So Ehang had finally filed the 20F for the fiscal year earning of 2020. From the brief of it in the news inside Futu, it did not look like any problem. In fact, in the morning, it was growing so strong, gapped up above the resistance and then continued heading north to grow as much as 17% and then crashing down super fast. This is sell the news action and probably digested some of the bad things in the earning. So in the afternoon, I shared this, that this was a bull trap with lots of selling volume. So a lot of people were trapped at the top. That means when the earning was out and it gapped up above, a lot of people FOMO inside and they were trapped right away. So I think it would take some time to digest this bull trap and might most likely fall back to lower support. And I drew out these supports here, and I really am not quite sure which one can hold. First support 36.8, second support 33.3, and third 29.8. And I don't think it would fall back to 27. Hopefully. But from the look of it, it might be off fire for a while. So best case scenario, it would go sideways to digest the run up, profit taking, and sell the news. And more likely to fall back to lower support, I think. And my guess would be around 33. But I think it might have some rebound first. Let's see. Now this is the earning that they filed today. The revenue part is nothing shining, nothing special, nothing we didn't expect. not specifically outstanding, we know that, and we have digested it already. Because if you had watched my video last Friday about EH earning concern from me, you should know why I'm concerned about potential problem of the earning, which would be the account receivable. And I have explained why in the video. So let's see. We have substantial customer concentration and we have experienced a significant increase in account receivable. Now that doesn't look good at all. Due to the short history of our business and we have not achieved significant scale, we had and expect to continue our customer concentration. In the past 3 years, the biggest customer account for 30, 24 and 51% of our revenues. That is very concentrated. So when they have a large concentration of customers, it would result in risk of having a large percentage of revenue concentrated into limit number of customers and would make it hard to predict the future level of demand. So it's hard to predict the future revenue, the revenue projection. And in addition, the account receivable balance significantly increased from RMB 2.5 million as of the end of 2018 to 41 million as of end of 2019, and then increased to 179 million. That's a big jump in the year of 2020. And the account receivable balance were mainly from the top 3 customers, and they account for 85% of the total account receivable. No wonder. So they usually would require upfront payment, and then they can pay the remaining accounts, and the remaining amount would be usually paid within 3 to 6 months, usually. But the thing is, because of COVID in 2020, they collected the payments later than the due dates from the contract. So in this year, their certain customers had signed the payment commitment letters. So this was what my concern was, the fact that they had trouble to collect payments from their clients. Client concentration is definitely a problem, especially in the past 3 years. Top 3 customers account for such a big part of the revenue. Like in 2020, it's 51%. Half of the revenue is from 3 clients. And these 3 clients also account for 85% of the total account receivable. And of course, LKNCY would be one of them, I assume. Now, from the look of it, it doesn't look good, and it is a concern for sure. As I said in my last video, I was worried that some of the clients heard that they might reduce their price later due to manufacturing capacity and mass production, and might have trouble to accept the previous payments written in contract, and worry that the team would have trouble collecting those payments back. But at least in the Q1 earning, the CFO did say they have reduced the account receivable from 179 million to 103 million. So they have collected 76 million, which is 42% of the total in the first quarter of 2021. So at least that's one good sign. So I don't know how the other investors, especially institutions, would take it. Especially this was written as one of the accused from the Wolfpack research. The one thing I don't agree with them was that I don't think it was because of insider deal or some under the table association. But at least right now it's providing a proof for the Wolfpack. So I don't know how the investor would take it. And maybe that's part of the reason why it drove a big sell-off today. The bigger institutions, I think they did know this before, or at least expected something like this. So it shouldn't be too much a surprise for them. And for me, myself, it was my worry before, and I had make peace with it myself. I had made video about it and prepare you guys. So I don't know if you had accepted it or not. Because for me, what I look forward to is the future of the company and not necessarily the old past. Because anyways, they had a very small base before, it was not scaled up. And the revenue from before, it's not really the most exciting. Because if we invested in Ehang because of the sales, then we should have known the PS ratio is super high. it would make this company way overvalued. But I think most of us invested in this company because of the technology being the most advanced in the industry, the fact that they are supported and incubated by the Chinese government, the fact that the Chinese market would be, I believe strongly, the first market to have eVTOL up and running into commercial use, and the fact that we agree with the vision of this company or the leader or management. It's not a good detail to live with, but not a disaster for me either, because if this is the news that the drone got on fire or the technology had problem, that would be a vital problem for investing in this kind of company. Now that's just my own opinion. With that said, I do think the big institutions knew this or expected this at least. So the fact that it gapped up above so strong and then turned 180 degree does seem like a big washing and shaking. Now selling high sometimes is because they want to buy it back at lower price. So right now it's up to you what you want to do, whether you want to hold on tight because you might sell and then it start flying again, or as short-term trade you want to exit and find opportunity somewhere else. It's completely up to you. Quick note on LKCO. Today there was not much movement. If it can stay above this gap for the next following few days and consolidate, it still look healthy. Support at 2.07 or 8. Today it touched this support and bounced back up, but the post-market seems like it's not holding, but post-market is not very accurate. If this doesn't hold, next support is 1.96, and that would mean it would fill part of the gap. I think a lot of the traders had joined the party and want to wait a little to see if it can continue running up, and if not, they would slowly sell out. So that's why it's normal for it to dip. You can consider taking profit if you are already happy with it. It had already a very strong, powerful run up, near doubling. So it would be completely normal to pull back further. It would be even normal to break the gap. Now what I regretted the most was that I did not remind anyone to take profit here. I did remind to take profit on this day and remind to trim on this day. So that's why I had reminded you to trim on this day, and I'm doing it again because I worry that you would get disappointed if it falls back down, or you can wait and see if the support holds first. Now surprise, surprise, I said Luckin Coffee is like our VIX index. When all the stocks is up, Luckin is down, and when all the stocks is down, Luckin is up. So this is our hedge, it's our VIX, and it's again true, happened so many times already. But it grew, I think maybe because it dipped quite fast to 3% and then slowly climbed back up to be 3% plus, close with 1%. But in a market like this, I have no complaint. Now, my Discord member asks about HOL. I have a small position in this, and like I said, for SPACs, I think you can either get in before and wait for the pop, be patient with it, or you can wait for the pop and then get inside. So it's up to you. For HOL, we bought in at this price, 10.7. Some of you might bought it later than me and cheaper than me. We have stop loss at 10 because 10 is the safety price for SPAC. So I think it's limited room to drop, but more upside than the downside. So I'm not too worried about this. The only cost is time, and it goes with all the SPACs. And today the SPACs had ran off BLDE, growing 7% when most of the stocks were down. I do think the money would be slowly getting inside the SPACs, and the moment they have bought enough, they would pull up. Because right now, a lot of SPACs appear to be a good deal. Still around 10 lying down on the floor. TKAT, I still have it because I have a very small position anyway, so I don't even bother to put a stop loss. I'll just let it run, see what happens. It's an entertainment purpose stock. Canadian stocks, Next Innovation looks interesting today, like they were buying the dip action. Cloud9 was up 5%, but I think most of you cannot buy in the Canadian market or OTC market, so I don't talk too much about it. Okay, now if you have enjoyed this video, please give me a big like and write me a great comment. That's it guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.